This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
Your average mom and pop rental in your average affordable housing unit is not actually listed online where someone's surveying that rent, including it in a rent index. And so it's apples and oranges. I think what you have to be able to do is you don't track incomes at the time of renewal, but you can look at two things. One, you can actually, this is what we do. I think a lot of larger property managers, you want to look, and small ones, you want to look at what's the rent income for actual households in your communities that for the time of lease signing. And then you want to look at your rent collection, people still able to pay the rent. And on a national level, and in most markets, we're still seeing rent income ratios for new leases in the low to mid 20% range. And we're seeing rent collections in the upper 90% range. And so that's for the market rate side. It's more challenging in the affordable space. And so overall, it's a good story. Again, my concern though, is people who are not even in those numbers because they don't qualify to live in the units that are available.
That's a good point. You said a lot of stuff there. And a survey like that that's comparing rent income ratios is almost doing it sort of the way the Housing Affordability Index does it, right? And there's a lot of flaws in that because, it doesn't survey who's buying what house. And it also doesn't count foreign money moving into a market. And of course, what it really doesn't count is people in a market that are already there buying a house, moving up and trading their equity. It just looks at median income, median mortgage payment, and that's very misleading. Yeah. Although it's a decent index other than that, but it does have a few big.
Well, all of these things are challenging. That's why I think you're right, but I'm very skeptical when I see these crazy numbers because the reality is no one's leasing to someone paying half their income on rent, and it just doesn't happen. And so to say it's the median, it's mathematically just very improbable to even get there unless it's an area like maybe Miami where it's so much retirement income or retirement money and foreign money where it's not even a W-2. It's just they've got a lot of wealth and it makes it look like the rent income ratio is a little out of whack.
Fair enough. But that's interesting because I just had a guy who wanted to rent one of my houses who's retired, doesn't have an income. Okay. Or, a big income. And, the rent for this property was fairly high. And I said, well, what's your income like? And he says, well, I'll just pay you a year in advance. And I'm like, okay,
Yeah, he's got savings, right?
So income wise, he was telling me he wasn't going to qualify. Right. Yeah. But he has money. It's not a problem. Yeah. So, interesting.
He'll take the year up front. Why not? So.
Yeah, right. Yeah. What about the institutional landlords owning single family homes? I'm talking about most of our listeners and audience are buying single family homes, some apartments too, but mostly single family. And this has really been a change coming out of the Great Recession, how we've seen just a huge level of interest from the big money, the smart money in single family homes, buying entire neighborhoods, huge portfolios, tens of thousands of single family homes. Overall, though, compared to the rental market size, it's still a drop in the bucket, but it is bigger than it's ever been that I know of. Talk to us about that market, what's going on there, what your thoughts are for the future of it.
Yeah, well, single family rental market is really seeing, I think, in some ways, just go back a little bit, great financial crisis, everyone's struggling with, foreclosures and whatnot. End up, obviously, as everybody knows, we start to see some institutional groups move in and buy single family rental homes. And then since then, but they've continued to be a presence in this market. But, even now, Freddie Mac did a study, I think a year ago, showing that institutional landlords were, I think it was less than 5%, maybe a 6, I forget. It's low mid single digit percentage of the market. But, they tend to be sort of an outsized, face of the market. And certainly, I think what we've really seen and now though is that, they've gone to the sidelines too. I mean, rates are high. They're using debt also, and also home prices are still high. Now, if only one of those things were true, I think they'd still be active buyers. But the combination of the two has certainly, I think, pushed a lot of folks to the sidelines at the moment.
Yeah, it sure has. So they're on the sidelines. So we've got this very weird market in real estate. I've been doing this an awfully long time, and it's just really, I still can't help but comment on it because we have very low inventory. Yet there's been a lot of demand destruction with the interest rate increases. So we've got sales activity down by, depending on who you ask and where it is, they're talking about 23% maybe decline in sales volume.
Yeah.
But still, we have only about 1/3 of the inventory of single family homes we need to be normal. Most people would say somewhere around there.
Yeah.
Normally, with these massive interest rate increases we've seen, you'd expect to see a flood of inventory coming on the market, and you'd expect to see a crash. Now, we're not seeing that at all. I mean, still what I call the crash bros are out there hoping for a crash because they've, mostly missed the market the last 10 years and they want to get in. And they tend to be rather jealous people about that. But what do you think about that? I mean, what do you make of this type of market?
Yeah, you're right. No, it's always kind of weirdly sick to me how many people, especially on social media, seem to be cheerleading a crash in the housing market and grand misery for half the population. I find that to be exceedingly bizarre. But
it's sick. It's a sickness. Yeah,
I'm glad they consistently are wrong. Not just for the rest of us, but also for the sake of our country's health. The fact that these people continue to be wrong. But I digress. No, I think what's happening is that you read all the headlines and home prices and incomes and inflation and everything's really negative, and certainly consumer sentiment has even been weak the last couple of years. But the reality though is that by and large, always there's exceptions, that by and large the people have fared pretty well over these last few years in terms of incomes and jobs. Unemployment the lowest level in multiple decades. Wage growth has been consistently the strongest in multiple decades. Wage growth is part of inflation too. And oddly enough, the Fed, obviously there's reason for this, but ironically enough, the Fed even wants to see wage growth levels come down. So there's been a lot of people have more money, and there's very little distress in the homeownership market right now. Most homeowners are in good shape. They locked in at low rates. They're sitting pretty. Why are they going to sell? Their mortgages are affordable. They aren't paying 8%. They're paying 3% and 4%. So you have this kind of unique dynamic where homeowners are fine for now, and hopefully that remains the case. But they're not incentivized to sell in many cases unless they have to.
Yeah, they're protecting part of their asset, which is the mortgage.
Yeah.
25% of the country has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. And 42% of the country has no mortgage at all.
Yeah.
How do you get distress out of that? I just don't see it happening. I mean, even if we see unemployment spike quite a bit, these people, number one, they could probably afford their mortgage with much lower income than they have now. And if they couldn't, I think they would still just beg, borrow, or steal to protect that mortgage and take on a roommate, Airbnb their house. Now that market's in distress too, but it's still there, right? They would just do whatever they could to make it work somehow.
Yeah, and also too, it's we learned a lot of lessons from the GFC period. Obviously, it's like we don't see the same issue with ARMs, and ironically, that's more of an issue now in not all of it, but some niche of commercial real estate, the equivalent of that with short-term floating rate debt. But it's really not an issue in the single-family market this time around. So it's not like everyone's resetting to higher rates. And so, I think, again, barring some big shock, I think we're in pretty good shape. And even a big increase in unemployment, we were at double-digit unemployment in 2020 and still, didn't see the crash that people expected to see.
Yeah, well, people are going to take issue with that. They're going to say, well, they put moratoriums on, all that kind of stuff.
But even that, I'd be curious to look at the number. And the stimulus money helped too, don't be wrong. But, again, the point being is unless you have a sustained shock, I think we'll be able to weather through. And I guess the other part of that too is most of these, banks are now set up to work with consumers much more than they did in 2008, 2009.
I agree. Yeah, so they're going to do workouts, loan mods, and
Yeah.
I think they're going to be more inclined to this time, not only because they're set up for it and they're mentally prepared for it, but also because, they're simply going to see that that borrower has a good chance of making that loan perform if it becomes a non-performing loan, which now there's like almost none of those in the entire country. So, it's
pretty much the only part of real estate seeing non-performing loans is the office sector. So, but most real estate is, and obviously residential, is in good shape.
Yeah. So the office sector is seeing that. And, retail's been under a lot of pressure for quite a while with the Amazonification of retail, the retail apocalypse. But how about the apartment market, though? I'm hearing some pretty decent, amount of stress with, a lot of apartment syndicators being willing to sell like general partnership shares just to get funding. They took short-term bridge loans, kind of expected appreciation. What are you seeing there?
Yeah, well, it's interesting because I think what's going to, first of all, it's not really showing up yet, meaning that like distress is not really bubbling up. Bank loans are getting paid, and also, Fannie, Freddie, life insurance companies, like there's no sign yet of non-performance other than a handful of deals that have made national news. And
there was a big foreclosure in Texas, I think,
and Houston,
430 units. Yeah, big one. Yeah.
One in San Francisco, and then there was one for a portfolio based in New York that has assets all over the place. But it's very limited. In fact, MSCI Real Capital Analytics had a report recently showing that distressed sales on a trailing 12-month basis are actually down. It's just the ones that are making a lot of noise. Now, that being said, here's what happened. So most of those, the peak was 2021, early 22, pricing, rates. And so deals that happened then using short-term floating rate debt and with value add plans. So the equivalent, basically, if you're not familiar, for those listening, not familiar with multifamily, the value add short-term players are kind of like flippers in the single family market. They buy a house, fix it up, and sell it at a higher price, or they refinance and cash out of it. So what's happened is that you're going to see some of these syndication groups, especially, who bought at those peak prices and aren't able to do the value add work, and also too are going to struggle at the higher rate when the 2 to 3 year term starts to mature, and so, or the rate cap expires. And so that timing really gets us to second half of this year and into next year. We will see more of that, but I've sliced this data lots of different ways. I mean, you're looking at a lot of this is, CMBS or CDOs, and that's a single digit percentage of the market. Most Fannie and Freddie loans, that's half the market for multifamily. And most of those are long-term mortgages that, with very few maturing in the next couple of years. And so by and large, the market's in strong shape, but there's going to be a lot of noise coming from a small segment of the market.
Do you see a lot more distress in the multifamily market, or pretty?
Well, there's going to be some second half of this year, next year, but again, it's not going to be systematic. There's going to be pockets of distress among some segment of the market that bought at peak prices with short-term floating rate debt. But again, we're looking at a single digit. It's a relatively small piece of the market. Yeah. And furthermore, I'll tell you what, there's a lot of what's so-called rescue capital lining up for these deals. And so a lot of that's going to get worked out behind the scenes with preferred equity and mezz loans. Right. And may never even, you never even see it officially default. So there's going to be some of that. But you look at the overall health of, the balance of multifamily debt in our country, it's just there's not enough of it maturing next couple of years to be a systematic problem, barring a much bigger shock.
Yeah, that's a good point. And we still have a housing shortage, regardless. Yes. Even with a big supply of new multifamily hitting the market, over, I guess, the past year or so, we've certainly all witnessed them being built in every city in America. So, but that'll get absorbed. I mean, how bad are those vacancies for the multifamily landlords?
It's so bad that we're back to normal. It's
so bad that we're back to normal. Yeah, I love it. That's a great line.
We were at 2.5% vacancy this time, basically this time a year ago, and now we're at 5.5% vacancy.
Oh, wow.
And even the great thing about having a real estate or a rental housing portfolio, whether you own single family, assuming you have a bunch of them, or Multifamily is like, you always have cash flow. It's not like office or retail where you have one company move out, you're at zero, sometimes or 20, right? A bad apartment complex could be 90% occupied. And so,
Right.
I think it's really important to point out is, again, barring a big shock, the issue for multifamily, even for the syndicators you mentioned, it's not occupancy and rents. Like everyone has some tolerance built in there to see, some movement, even rents could go negative. But the issue is entirely related to the expense side of the ledger, and especially the cost of debt. And so that's why those with short-term debt are facing some challenges, and especially in places like Florida, where the cost of insurance is doubled or tripled as well. And that adds another layer of challenge to the expense side.
Right. Yeah, it's definitely an issue, but overall, those expenses pass through to tenants because there's just no supply if the landlords can't pass it through. And that's ultimately what happens. The thing that hurts, though, is that 2-year adjustment period. There's always an adjustment period in every market and every type of market and every asset. And that's the part that really gets people. And
you can't pass it all down at the same time. And again, especially for those that are in that situation I mentioned earlier, is if you are seeing increased vacancies, you can't pass all that down to the resident in a 1-year period. And so
of course not. Yeah.
It's going to be challenging for pockets of the market in the short term. But I think, again, long term, we need more supply. So it'll be the demand will be there.
That's the nice thing. At least every investor knows that we need more supply. And if you have supply, the world is somehow going to want to rent it from you, or buy it from you. So that's good. You mentioned, of course, the office market, which is in major distress. COVID just changed the game as far as office and hybrid work schedules or completely remote work and so forth, and the move away from cities to suburbia. What do you think about the reuse? I watch a lot of YouTube channels about the reuse of shopping malls, converting them to housing, converting office buildings to housing. These conversions are expensive. I mean, I even wonder if they're practical at all, or it's just better to start over from scratch. But do you think we're going to see a significant supply of residential units come from conversions of offices, shopping malls, anything else?
Well, I wish I can say yes, because I think those projects are always so cool. It's such a great, adaptive reuse is such a great concept for many, many reasons. But unfortunately, as you allude to, it's just not practical. And these deals are expensive. Conversions are oftentimes more expensive than just demolishing and starting new. But also, too, a lot of these buildings, especially office buildings, are not, the building plates are not conducive to residential, meaning like they're so deep that you can't build, apartments or residential units inside these places. You have really long, awkward floor plans with a lot of windowless bedrooms and some
no
cities,
plumbing.
You have to redo a whole building, plumbing, electrical, all that kind of stuff. So it's a lot of drilling through concrete and building in new things. So it's just not easy. And the ones that do happen tends to have, usually, like a lot of times everyone pictures these in their minds, but the cool ones that we've all seen are usually associated with some sort of historic building tax credit. And, again, there's only so many deals that are really going to fit that profile. So we'll see more of it, but it's not going to move the needle in terms of overall housing stock, unfortunately.
It's not going to solve the shortage problem.
No.
And is anything else a disruptive technology like 3D printed houses?
Yeah.
I know the answer. It's not, but I'm just curious.
No, it's not. But I will say, I think the answer is more all the above as opposed to, one thing. I will say it's like, Greystar recently, the biggest property manager in the country, they're working on, they have now built a factory to build modular apartments. And, it's great. I think the more we try different things and try to combat the cost of construction for new housing is worth trying. So I'm hoping that we can come up with some different ways that collectively help move the needle.
Yeah, that's a good point. It's not one thing, it's a whole bunch of things doing this, that, and the other thing. It's great having you on, Jay. What else do you want people to know? What do you want to share as we wrap it up?
Well, I guess the one last thing I would share is that as you introduced me, and I'm a big believer that rental housing is essential, it's important, it's misunderstood. And I think especially now when, all the so-called, as you mentioned, like the crash bros and the housing bubble people, and you're starting to hear the same thing now for the apartment stock people, that everyone's excited to watch a crash of some sort. But, it's the long term, as you alluded to, you said it several times, is we still need housing. And I think that for housing investors, especially if you have the ability to be longer term investors and you're not as sensitive to what happens the next year or two, given all the noise in the economy and whatnot, then, you're going to be fine by and large for the most part. And housing is essential. And I think COVID reminded us of that. You could work from anywhere, you can shop from anywhere, but you can order food from anywhere. But at the end of the day, you need a place to live. Yeah. And I think that's a big tailwind for housing of all types.
And that place to live has actually become more important if it becomes your place to work too.
Yeah.
So it's like doubly important now. So yeah, very interesting points. Jay, give out your website or Twitter or whatever you want.
Yeah, well, you could find me on Twitter, just at Jay Parsons, and also I'm on LinkedIn. I post there a lot, and our website is realpage.com/analytics. We have a blog there. Our team posts a lot of articles there as well.
Excellent. Jay Parsons, thanks so much for joining us.
Thanks for having me, Jason.
So George Gammon, Jason Hartman, and I, we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the three of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to The Collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do, that basically runs almost without me. So that's what I'm going to bring to The Collective. We decided to start The Collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which, quite honestly, I was super focused on real estate almost the entire time, and even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single-family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought The Collective would be good, because I think everybody's kind of searching for the same kinds of answers. So The Collective means to me basically the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration, of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through. And so it's very, very cool to get into one room with like-minded people. I think the right person for The Collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth, and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of The Collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are going to certainly get that out of there. They're going to have lifelong friends for sure from this, and they're going to meet people at every single event. But also, we're going to have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are going to be part of it. So it's kind of a, how do we have fun and learn together? And we're going to have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.